Welcome back. As we continue to digest North American jobs numbers, let's turn to what's happening in the markets this morning. We're joined by Michael Green, Chief Investment Strategist at Simplify Asset Management. Michael, thanks a lot for joining us. Your take on the Canadian and U.S. jobs numbers very quickly?
Well, unfortunately, I think both were very weak. Substantial downward revisions in the United States, where we continue to be challenged by what's referred to as the birth-death model that is simply overstating the quantity of jobs that are being created in the United States. The Canada data, I heard your earlier guest referring to it, a shockingly low number given the population growth.
Okay, what is your take on North American equity markets as we begin the second half of this year?
Well, I mean, there's been an extraordinary divergence when we talk about North American equity markets. We're thinking primarily Canada and the United States. The United States, in the form of the S&P 500, continues to power ahead. The NASDAQ 100 obviously doing even better. Canada has been a pale imitation of that, particularly on a currency-adjusted basis. When we think about the behavior of Canadian markets, they've continued to be extraordinarily weak for an extended period of time. That defies commodity cycles. It defies the traditional metrics. My analysis suggests that the primary driver we're seeing in the United States continues to be the almost universal flow into passive strategies as pushing up the largest stocks, reinforcing momentum dynamics, and unfortunately actually hiding the economic signal that's occurring behind the scenes, where the majority of stocks are significantly lower than they were back in 2021.
Interesting.
So we have a very bifurcated market.
Sorry, interesting to hear you say you think index investing is a major factor here.
I think it is a major factor. And I think the data is increasingly coming in from the academic community that they're recognizing there is no such thing as passive investing. The fact that they transact in the scale and size that they do is absolutely influencing market behavior.
And you do not see Canadian stocks outperforming U.S. stocks in the back half of this year. Canadian stocks underperformed in a big way. The TSX did finish in positive territory for the first 6 months of the year, but not nearly like its cousins in the U.S.
Yeah, I mean, if you look at its cousins in the United States, I would encourage you to look at things like the Russell 2000, or even more profoundly, the Russell 2000 equal weight, which represents the majority of stocks in U.S. markets. That's actually down significantly for the start of the year. That's been a recurring pattern, just like the Canadian markets have been weak. The U.S., the majority of stocks have actually been quite weak for the past several years. And again, I really think the driving component here is the influence of passive investing.
How do investors respond to this type of environment?
Well, unfortunately, the challenge is that, if you have a mechanical behavior that is inflating markets, the natural and logical response is to continue to participate alongside it, even though you recognize that there is significant risk, right? We are all in this collectively together. This is a variant of the famous Chuck Prince line, when the music's playing, you've got to keep dancing. We remember that because it was so wrong in its timing. Unfortunately, that's really characterized components. And when you think about Canadian investors themselves, and this is true for the rest of the world, you're significantly over-indexing to the United States, both due to the performance reasons and because you tend to think in terms of a much more global perspective than U.S. investors. That in turn is actually feeding this phenomenon. Nobody is seeking out Canadian markets, or very few people are seeking out Canadian markets to invest while they're doing so on a religious basis into the United States. So it's really a market phenomenon rather than an economic signal. Unfortunately, as the economic signals weaken, that bifurcation, or what I would describe as the misinformation that's being received by policymakers about the status of the U.S. economy, is growing more important. Canada, whose economy is largely a derivative of the United States economy, becomes even more at risk because of this dynamic.
So it sounds like you think major indices are overstretched, overvalued. How do you think investors should be positioned right now?
Well, I think we're in a really interesting position where with the uncertainty of policy response to what might happen, if I'm correct, if the economy weakens, we're all very afraid that governments would quote unquote print or run extremely inflationary policies in response to economic weakness. But in the United States, I'm less familiar with the inflation-protected bond market in Canada. In the United States, you're actually being offered a very attractive risk-adjusted inflation-protected bond yield north of 2%. I just encourage people to remember that you're trying to meet your individual objectives rather than trying to quote unquote keep up with the Joneses in investing right now. You're being given what I think is a really remarkable opportunity to buy positive yielding, inflation protected securities in that form. And so I personally am heavily invested in TIPS, as are the funds that I manage.